This is what investors normally expect, right? A 12% of consistent return is what equity will deliver. But what the reality is, the returns would not be consistent. I mean, if you look at the right hand chart, just a representation, but you will see that at some point of time it's a 8% return, sometimes it's a minus double digit return, sometimes it's a positive high double digit return. I mean, you have all of these phases. Why I'll again point out why investment return and the actual fund return and the investor return is and can be very different. And the experience of investor while investing is so very important. We've seen a lot of times that when times are good, people want to be with that asset class. In fact, people want to add to that asset class, as I said earlier as well. But when things go bad, which is where people would not want to add. So when you look at the kind of flows which come into asset class, even for this example in fixed income as well. I mean, that investor behavior is not very different in fixed income as well. 2013 was a period where a lot of money came into fixed income, particularly in the GSEC segment. I remember at that point of time, markets were giving calls that 10-year would keep coming down, and it had done well over 2011 and 2013 in that 2-year period. But that was, I think, a kind of peak in that market, and investors were overly invested in the asset class, and post that there was a shock, and people had to bear the burden of that shock. The returns still, for a longer period of time looked good, but for that period of time when investors actually invested, the experience was not good. So these kind of products, which are hybrid products, they increase the experience of investors rather than the fund returns. So from an experience adjusted perspective, I think hybrid funds are much better compared to a plain vanilla fixed income or a plain vanilla equity kind of a product. So this is what I was talking about, that this is what investors normally expect, right? A 12% of consistent return is what equity will deliver. But what the reality is, the returns would not be consistent. I mean, if you look at the right hand chart, just a representation, but you will see that at some point of time it's a 8% return, sometimes it's a minus double digit return, sometimes it's a positive high double digit return. I mean, you have all of these phases, but the problem is, if at a point where you get a negative return and then you change your asset allocation after that negative return and then switch to a different asset class. Here we have given an example that you were invested in equity, which delivered 8%, which was kind of a fixed income return, and then next year you lost 14%, and then you reverted to fixed income. The overall experience for that investor is just about a 3% return, which is a very, very low outcome. But at the same time, if you would have maintained either a consistency or contrarian cyclicality in this, where if you're seeing that something which is in a negative cycle is bottoming out, even though the past returns are bad, you increase your exposure. At the same time, on the other side, if you're seeing something which is doing very well, but it looks very expensive cyclically at the peak, you move out of it. Your instead of 3%, your returns will be much higher than what the other two asset class normally deliver. So another example of diversification, how your returns get diversified if you have invested in a hybrid kind of a structure. A clear example is 2011, where equity gave a negative 24% return. The debt portfolios on average they generated 18%. As I said, 2011 2013 was a great period because interest rates were peaking and then they started coming down. So therefore, there was a lot of capital gains beyond what a normal yield on the portfolio was. And therefore, if you had a 50-50 debt or equity portfolio, you still managed to have close to 0% return, while equity gave a minus 24% return. And if you continued with that strategy over the years, you would see that your returns normally get hedged, and the outcome is more stable compared to look at the left hand point where you have a very inconsistent outcome. uh,
I'll quickly move to the equity savings as a category, Manish. And like you mentioned again, this category has become very interesting because of the tax law changes that happened last year, and the AUMs in the industry has sort of doubled. What are few things that one has to be careful, because here the net equity is not defined, which means that it can vary from AMC to AMC. So when
right, right.
somebody as an advisor is making a comparison, what are things that we should be looking for in an equity savings product before we place it in a client's portfolio?
Right. So you should first read the communication which the AMC sends you in terms of how the product is positioned. And different AMCs, as you rightly pointed out, will have different positioning. And because the category is such that you can have active equity exposure to the extent of 50%, the product's final outcome and results can be very different. And therefore, to compare different products of the different AMCs is not also correct, because the risk profiles could be very different. So first you read the material which the AMCs share with you in terms of what the product is about, right? So for example, I can talk about the equity savings product which we have at ICICI Prudential. We manage it in a way which kind of comes with a very low equity exposure, and the idea is that we want to make this product more like a arbitrage plus kind of a product. Whereas there can be a case that some other AMC can be running this product with a much higher equity exposure, which could be in the range of 30-50% as well. So don't treat all equity savings products similar to each other. And therefore, don't look at just the returns part of it. Look at what the construct is and whether that suits you or not. It may be possible that you may want to have a 50% kind of a equity exposure, and you may want to get into that kind of a equity savings product. Then I think it doesn't make sense for you to get into our equity savings, because we are more like a equity arbitrage plus product. But if you want to park money for shorter periods of time and you want a solution for that, I think then it makes sense to come to ICICI Prudential equity savings kind of product.
And so to that extent, not just placing, the time horizon can also vary. Like you take one equity savings for a fund which has like a 30-40% allocation, you might want to do at least a 3 year sort of an investment.
Right.
But like you mentioned in your presentation, an ICICI product can possibly be suitable for a 1 year as well, is what you are saying.
Right. So effectively, look, the way you run it is, if your equity exposure is very less, you are more like a debt fund,
Yeah, yeah.
right? Debt or an arbitrage fund, right? And if you're running it with a higher equity exposure, you're more like a balanced or a aggressive hybrid fund.
So again, here also I was looking at like 3 year rolling data for the equity savings as a category, and like you rightly mentioned, there have been funds which have given negative returns over 3 year period also when the equity markets have not done well. But do you have some data on, like, say how, because ICICI has like lesser equity, what has been the typical outcome around this category?
So our eventual goal is that given that larger part of it remains in arbitrage or fixed income, that as I said, generates a lot of stability for investors. I mean, we know that arbitrage is also a fixed income kind of a product in terms of its outcome and return outcomes. The 10% which remains, right, out of that, at ICICI, what we do is 5% we do take equity, active equity calls, but there is a 10% part of the portfolio which we kind of hedge with instruments like call options, right? And we believe that call option kind of instrument is a great strategy, given the fact that you kind of normally run, returns of 1.5 to 2.5% every month. So think about it. I mean, 1.5, 2.5 every month. If I do it for every month, the total option income which I'll earn will be closer to 18 to 30% in that range. And if the stock fluctuations over that period is less than that, I end up making higher returns.
Can you
And this been
explain
our
this option writing? What exactly is this like? What exactly do you guys do here? Just so that everyone
So, for
understands.
example, say a stock ABC, right? I have that stock in the portfolio because that is needed for me to take some the fund is about 15% active equity, right? But I take that stock, right? And then I I write a call option against it, right? And what do you mean by call option writing? Effectively meaning that I have a stock, right, and I write a call option, right? If the call option at the expiry, right, if suppose the prices go up, I will have to give away the stock, but I earn a premium out of it, right? Suppose the stock is at 100 rupees right now. At the end of expiry, stock becomes 105, right? I earn a premium of 2 rupees by writing the call option, right? At 105, I have to give away the stock. My net return on that would be 2 rupees for that month because I had the underlying stock. So I am not taking a naked writing exposure. I have the underwriting, the underlying stock, and therefore I earn a return out of that premium which I incur. And what I'm saying is that range of premium is 18% to 30% on an annualized basis. Right now, suppose the stock goes lower than 100 rupees. So I'll be protected to the extent of 2 rupees, and if it goes lower than that, then I'm exposed to that risk. But we believe that 18 to 30% which you earn in a year is good enough to take care of those exposures. And we do actively get into only stocks where we believe that the downside is to that extent a little.
Fair
So
enough.
which is the idea is to earn some returns out of options, and we think that this is a great market to do that because market is so bullish that both on futures and options the F&O segments become so large that you get so much of premium a writer can generate, and that kind of strategy delivers alpha over and above the arbitrage on this.